Good afternoon. My name is Brian Shannon from Alpha Trends Blogspot. Today I'm going to take you through a quick tutorial on the MACD. The MACD is short for Moving Average Convergence Divergence Oscillator. It's quite a mouthful, but it's actually a pretty simple concept that regards market momentum of whatever it is that you're studying, be it individual stocks, currencies, oil, whatever it is. What it does is it measures the intensity and the direction of a trend. The way it's calculated is by using three different exponential moving averages. The way these moving averages are used traditionally are a 12-period exponential moving average, 25-period exponential moving average, and a 9-period exponential moving average. The key word there is period, because you can calculate it on a daily time frame, a weekly time frame, even a 1-minute time frame, and you're still going to see the same types of signals showing up. Now, the way the MACD itself is actually calculated is it's the distance between that 12 and 25 period moving average. So the 12 period moving average is going to follow the action of whatever it is that you're looking at much more closely than the slower, longer term moving average, which would be the 25 period. So it's the distance between those that is what the MACD is actually measuring. The 9-period exponential moving average is overlaid on the MACD as a signal line. And a lot of people like to use indicators and oscillators as trading systems. I think it's a big mistake. I think that they're good for identifying ideas and areas where there might be a potential reversal or something, but to go ahead and use it as a strict system is a big mistake, and we'll see why shortly. Generally, the way you look at the MACD is the way it's represented is down below the price, and we'll see it in a moment. Anything above the zero line is generally considered bullish. Anything below the zero line is considered bearish. So here we see it on this chart. And I've taken all references to price, to the name of the stock and time, so we don't get hung up on that. But the point is, we've got this zero line down here where I'm scrolling my mouse along, and that's the zero line. Below that zero line, the boxes that I have in red is considered generally negative momentum, whereas the positive momentum occurs in these green boxes. And you can see it does a pretty good job of isolating the strength and weakness in the market. What I think that you should pay more attention to, though, is the direction of the MACD rather than whether it's above or below the zero line. Now, there's a lot of scans you can do for, show me stocks that are above their zero line or below their zero line, and a lot of times it's a good starting place to find potential candidates for trading. Here we can see that what I've done is shown the same exact chart, but here we see that the MACD is the red line rather than right here where we have it represented as a histogram. They represent the same exact thing, and I'm kind of switching back and forth here a little bit so you can see that that red line coincides exactly with these peaks in the histogram. Personally, I like to view it as a histogram better. It just makes it a little bit easier to read. Crosses above or below the zero line are a lot of times they're actionable events to either buy or sell. Here we can see that the MACD crossed above the zero line right here, so you would be in about 25. But look at this, horrible exit down at 23. This one would have been a nicer one. And so it tends to be, especially on a daily time frame, if you're going to look at it that way, it's going to hold you in for maybe a month or so on these trades. I don't think that's the best way to use the MACD. And I actually don't even use the signal line, but I want to explain it here so you can see how it's traditionally used. The signal line, again, is a 9-period exponential moving average, and that's going to cross above or below the MACD, which again was the distance between that short and longer term moving average, the 12 and 25 period. An upward signal line cross through the MACD is considered bullish. A downward cross through the MACD is considered bearish. The problem is you're going to see a lot of back and forth action, exposing your account to a lot of unnecessary trades and whipsaws. So here we can see on this stock, look at this period in here where we're in and out, and really for no net gain at all. So I don't really like to use the signal line. What I like to use instead is I like the MACD for divergences. In particular, when the market is making a lower low, but the MACD is making a higher low. To me, it represents a loss of momentum in the market. So the divergence is a difference between the price trend and the MACD trend. So a lot of times you'll see, like I just mentioned, maybe the market is sold off and made a lower low, yet the distance between those moving averages is constricted, meaning that the velocity of this move down isn't as great. So there's not as much fear in the market, meaning that it might be time for this market to potentially turn. So it's an early warning that you ought to look at other time frames and start to think about the potential for getting long. A divergence occurs, like I have here, as the momentum slows down in a trending market. The positive divergence is that the MACD makes a higher low, but the price makes lower low. Okay, and that's what I just described. So we have the market trending lower, but then the MACD is making these higher lows. A negative divergence, which I don't think is good for trading opportunities. You would use it, I think, to potentially isolate some short sale opportunities. But I think that the positive divergence works better because there tends to be a lot stronger emotion associated with a bottoming process rather than a top. But the negative divergence means that the MACD makes a lower high, but the price makes a higher high. Now, what you'll see, though, is that a lot of times these divergences can go on and on for a while before we get any real action. Here we can see on this first down move that the MACD was going lower with the market here. The market made this first low at about 82, then at about 78, but there was a lot of fear associated with that in there. Then as the market rallied up, the distance between the moving averages got less, and that's where we have this negative divergence. And then it did start to fall. Over here on this side, we had this first low, and you can see how deep the MACD went on that low. And then as the market made a lower low right in here, there wasn't as much fear in there. And there probably wasn't as much volume either. You'll notice that volume tends to coincide with these divergences. And we saw a very nice, sharp, sudden reversal in this market. What I'm going to do right now is, now that I've given you a small example of how it's used or how to interpret it, I'm going to give you a strategy here for using it, something I developed a couple years back. And this is just a swing trade setup with a MACD divergence. And basically what we're doing is we're going to look at the end of the day for a downtrending stock on a 60-minute chart. We'll take a look at a few of these. And then what we want to do is utilize a shorter term time frame. So we're looking for the stocks in a downtrend. It's below its 10 and 20-day moving averages. And you can put those on your 60-minute chart, as you'll see in a moment. You want to look for stocks that trade a lot of volume, at least 1 million shares a day, and you want the MACD to be showing a divergence. In other words, you want the MACD to be making a higher low when the stock makes a lower low. So let's take a look at a couple of examples in a moment. First, that's what you look for on the hourly time frame. And this will become clear in a moment when we look at some examples. But then you want to determine where to enter and exit that trade. So this is a counter trend trade. So right away, I would say use smaller share size, because anytime you're trading against the trend, my belief is you've got much higher risk. So in order to enter this, once we've found the opportunity on the hourly time frame, we're going to look at a 10-minute time frame for our entry, and we're going to look at a couple moving averages there. The longer term trend on that time frame, the 10-minute time frame, would be represented by a 100-period moving average. We're going to set our stop below the most recent higher low, and we're going to exit as the stock crosses below the 50-period moving average. Let's take a look here. So here we've got this stock that the green moving average represents the 10-day moving average. That's a 65-hour. And this black is a 130-hour moving average, which represents the trend over the last 20 trading sessions. So as the market makes this lower low, we can see it first makes this low at about 13 and then at 12. We see the MACD diverging. And again, like I said, the volume was much stronger over here than the second one. So that's where we want to find the opportunity. Then what we want to do is, once we found that opportunity, these are those lows again, as it crosses above that green moving average, we're going to set our stop below the most recent higher low, which was right here, okay, at about $12.70, and exit as it breaks down through the intermediate term moving average right here. So this was a course of about a day and a half, 2 days, and it went from 13. We would have exited at $14 a share. Here we see another divergence where it makes this low. We didn't see the volume this time, but the divergence was definitely there from the MACD, and as we look at the 10-minute time frame, we can see our entry would have come over in here and our exit over at that point. Another one here is in a little bit higher price stock. It drops to about 52, then at about 51, and we can see that divergence. And here we did have big volume, and the distance between the moving averages was lesser. So we look at that 10-minute time frame. We buy right here as it gets above that 54 level, and this would have been a nice about 4-point trade or so. So there's a couple more examples here. I'm not going to talk through each one of them, but I just want to show you the way to look at them is first you identify on that hourly time frame where the divergence comes in, and then you look at the short-term time frame to come up with your entry. Now, this is a very simple entry and exit strategy. You could probably come up with something a lot more concise or something that meets your own strategy, your own risk tolerance, and that sort of thing. You know, expand upon this. There is no foolproof system out there. Every trade has to have a stop on it. The time frames I'm using are generalizations as far as, you know, when to enter and when to exit. The most important thing that you can do as a trader is to learn the psychology of what these indicators mean. To learn to listen to the message of the stock. Learn to listen to the message of the market. The message of a MACD divergence is the emotion isn't as strong on this sell-off, the second test, you know, when it drops, let's say, to 50, then to 48. We have a MACD positive divergence. It's saying at $48 a share, there's not as much fear as there was at 50. So there's not as much dumb money throwing their stock away. Therefore, there's a potential that you ought to look at this vehicle as a potential candidate to move back to the upside for a little bit of a bounce in this overall stock that's trending lower. My name again is Brian Shannon. Thanks for looking at this. I hope you found it useful. You can contact me at alphatrends@gmail.com. Also be sure to visit my blog. Thanks for your time and have a great day.